Right now, while you are scrolling through social media and checking your bank balance online, while financial experts are discussing interest rates and economic indicators, a fundamental change in banking law has quietly eliminated the legal protections you thought existed between you and your deposits. And here is what should alarm you profoundly. This is not a proposed regulation that might happen in the future. This is not a conspiracy theory being discussed on fringe websites. This is established legal framework, ratified through international agreements, and implemented into domestic law that explicitly reclassifies your bank deposits from protected customer property into unsecured debt that the bank owns and can use to recapitalize itself during a financial crisis. Before this video ends, you will understand exactly when and how banks gained this authority, which specific mechanism to allow them to seize deposits, and most critically, what you must do immediately to ensure your wealth cannot be confiscated when the banking crisis arrives. In 1933, during the depths of the Great Depression, the United States government created the Federal Deposit Insurance Corporation to restore confidence in the banking system. Thousands of banks had failed. Depositors had lost their life savings. The entire financial system was on the verge of complete collapse. The FDIC was designed to guarantee that if your bank failed, the government would make you whole up to a certain limit, which today stands at $250,000 per depositor per institution. This created a social contract. You deposit money in a bank, the bank holds it safely. If something goes wrong, the government insurance fund protects you. For 90 years, this system functioned largely as intended. Banks that failed were seized by regulators, deposits were protected, shareholders and bondholders took the losses, the taxpayer occasionally funded bailouts, but depositors remained whole. This created moral hazard and encouraged risky behavior by banks that knew they would be rescued, but it protected ordinary citizens from losing their savings. That system has been fundamentally altered in ways that most people do not understand and that have not been clearly communicated to the public. In 2008, the global financial crisis nearly destroyed the banking system. Lehman Brothers collapsed. Bear Stearns failed. Merrill Lynch had to be acquired in an emergency sale. AIG required a government bailout exceeding $180 billion. The contagion spread to Europe, where banks in Ireland, Spain, Greece, and Cyprus faced catastrophic losses. Governments responded with massive bailouts funded by taxpayers. In the United States alone, the bailout programs totaled several $1 trillion when you include direct capital injections, asset purchases, and emergency lending facilities. The political backlash was severe. Citizens were outraged that banks that had engaged in reckless speculation were being rescued with public money, while homeowners who lost their houses received minimal assistance. The criticism was valid and intense. Politicians promised that taxpayers would never again be forced to bail out failed banks. They promised that future bank failures would be resolved by making the bank's creditors and shareholders absorb the losses, rather than shifting costs to the public. The solution they developed was called bail-in legislation, and it represents the most fundamental change to banking law since the creation of deposit insurance. The concept is straightforward but devastating. Instead of the government bailing out a failing bank with taxpayer money, the bank bails itself in by converting its debts into equity. In practice, this means that when a bank faces insolvency, regulators can freeze your deposits, cancel a portion of them, and give you shares in the restructured bank instead of your cash. Your deposits are legally reclassified from money you own that the bank is holding into unsecured debt that you have extended to the bank. As a creditor, you can be forced to participate in a recapitalization by accepting losses on your claim. This is not theoretical. This is legal framework that exists right now in virtually every developed economy, including the United States. The international agreement that established this framework was developed by the Financial Stability Board, a body created by the G20 nations to coordinate financial regulation globally. In 2011, the FSB published Key Attributes of Effective Resolution Regimes, which outlined the bail-in process and called for its implementation across member countries. The United States incorporated these principles into the Dodd-Frank Wall Street Reform and Consumer Protection Act, signed into law in 2010. Title II of Dodd-Frank grants the Federal Deposit Insurance Corporation expanded resolution authority that allows them to resolve failing banks through mechanisms that can include imposing losses on depositors above the insurance limit. The Dodd-Frank Act specifically states that the FDIC has authority to treat similarly situated creditors differently based on systemic risk considerations. This language is deliberately vague but provides legal cover for discriminating between different classes of depositors and creditors when resolving a failed institution. The European Union implemented even more explicit bail-in legislation through the Bank Recovery and Resolution Directive, which took effect in 2016. The BRRD requires that all EU banks have sufficient bail-inable liabilities to absorb losses in resolution. Deposits above €100,000 are explicitly included in the bail-in hierarchy. The directive mandates that shareholders and creditors, including large depositors, must absorb at least 8% of a bank's liabilities before any public funds can be used. This ensures that depositors will take losses before taxpayers provide assistance. Similar legislation exists in Canada, Australia, the United Kingdom, and virtually every major economy. The global banking system has been restructured to permit the seizure of deposits during financial crises. This restructuring happened largely without public debate or understanding. The media coverage focused on protecting taxpayers from bailouts, which sounds reasonable. What was not clearly explained is that protecting taxpayers means exposing depositors to losses. Now let me show you exactly how this works in practice, because the Cyprus banking crisis of 2013 provided the first real-world test of bail-in procedures in a developed economy. Cyprus is a small island nation with an oversized banking sector. Cypriot banks had invested heavily in Greek government bonds, which lost most of their value during the Greek debt crisis. By 2013, the two largest banks in Cyprus were insolvent. They had assets worth far less than their liabilities. Under the traditional approach, the European Central Bank and International Monetary Fund would have provided a bailout similar to what Greece, Ireland, and Portugal had received. The Cypriot government requested approximately €17 billion in assistance. European finance ministers rejected this approach. They demanded that Cyprus implement a bail-in that would force depositors to absorb a significant portion of the losses. The initial proposal called for a tax of 6.75% on all deposits below €100,000 and 9.9% on larger deposits. This created immediate panic. Cypriots lined up at ATMs trying to withdraw cash before the levy could be imposed. The Cypriot parliament rejected the plan after massive public protests. The revised plan was even more severe for large depositors. All deposits below €100,000 were protected. All deposits above €100,000 at the two largest banks were frozen and subject to bail-in. At Laiki Bank, which was the second largest bank in Cyprus, depositors with balances above €100,000 lost 100% of the amount exceeding the insurance limit. Their deposits were completely confiscated. At Bank of Cyprus, the largest bank in the country, deposits above €100,000 were initially frozen. Eventually, approximately 47.5% of those deposits were converted into equity shares in a restructured bank. The remaining 52.5% stayed as deposits but were frozen for extended periods. Depositors who had kept their life savings, their business operating funds, their retirement accounts at these banks discovered that their money had been seized and converted into shares of nearly worthless banks that had just failed. The equity they received was essentially worthless. The bank's stock prices collapsed. Many depositors lost everything above the €100,000 threshold. This was not a rogue action by Cypriot authorities. This was the official policy of the European Union and the International Monetary Fund. Jeroen Dijsselbloem, who was president of the Eurogroup of Eurozone finance ministers, stated publicly that the Cyprus resolution should serve as a template for future banking crises. He said that pushing back the risks to investors and depositors was the correct approach and would be the model going forward. This was an explicit endorsement of bail-ins as standard policy. The message was clear. When banks fail in the future, large depositors will absorb losses before taxpayers provide assistance. The Cyprus precedent established that deposit confiscation is not only legal, but is the preferred resolution mechanism for banking crises in the modern era. The reaction from global financial markets was illuminating. There was brief concern about contagion to other peripheral European countries, but that faded quickly. The broader message that markets took from Cyprus was that bail-ins could be implemented without triggering systemic collapse. Depositors in other countries did not panic and withdraw funds. The precedent was set without catastrophic consequences. This emboldened regulators and policymakers who had been uncertain whether bail-ins could work in practice. Cyprus proved the concept. It demonstrated that you could seize deposits, impose massive losses on creditors, and restructure banks without destroying the entire financial system. The lesson learned by regulators was that bail-ins are viable. The lesson that should have been learned by depositors everywhere is that your money in the bank is not actually your money once you deposit it. it becomes an unsecured loan to the bank that can be confiscated if the bank fails. Now let me show you the specific legal mechanisms that make this possible in the United States, because the framework exists and could be deployed rapidly in a crisis. The FDIC operates under two different resolution authorities depending on the size and systemic importance of the failing bank. For smaller banks, the FDIC uses its traditional receivership authority under the Federal Deposit Insurance Act. This is a familiar process where the FDIC seizes the bank on a Friday afternoon, operates it over the weekend, and reopens it Monday morning, either under new ownership or with deposits transferred to a healthy institution. This process generally protects all depositors, even those with balances exceeding the $250,000 insurance limit, because the FDIC tries to arrange a purchase and assumption transaction where a healthy bank acquires all the deposits and performing assets. Depositors rarely lose money in small bank failures under this process. For large systemically important banks, however, the FDIC has different authority under Title II of the Dodd-Frank Act. This is called the Orderly Liquidation Authority, and it gives the FDIC sweeping powers to resolve a failing institution in ways that can impose losses on creditors, including depositors. The OLA allows the FDIC to create a bridge financial company that takes over the critical operations of the failed bank while leaving behind the losses in a receivership. The creditors of the failed institution, including large depositors, can have their claims written down or converted to equity in the bridge company. The FDIC has explicit authority to treat different creditors differently based on what they determine is necessary to preserve financial stability. This means they can choose to protect some depositors while imposing losses on others based on subjective judgments about systemic risk. The FDIC published a detailed strategy document in 2013 explaining how they would use the OLA to resolve a large failing bank. The strategy is called Single Point of Entry Resolution. Under this approach, the FDIC would place the parent holding company of a failing bank into receivership while keeping the operating subsidiaries functioning. The losses would be absorbed by shareholders and unsecured creditors of the holding company, including holders of senior debt and potentially large deposits at the parent level. This would recapitalize the bank without using taxpayer money and without disrupting critical banking operations. The FDIC estimates that large banks have sufficient loss-absorbing capacity through equity and long-term debt that depositors should not need to be bailed in. However, the authority to bail in deposits exists if the losses exceed available capital and debt buffers. The critical detail that most people miss is that deposit insurance only covers $250,000 per depositor, per institution, per ownership category. Anything above that threshold is legally uninsured and would be treated as an unsecured claim in resolution. If you have $500,000 in a checking account at a major bank and that bank fails, $250,000 is protected by FDIC insurance. The other $250,000 is an unsecured claim that could be written down, converted to equity, or frozen for extended periods. You are not guaranteed to receive that money back. Most wealthy individuals and businesses keep deposits well in excess of the insurance limits because it is impractical to spread funds across dozens of different banks. These large depositors are the ones who would be bailed in during a major bank failure. They are the intended loss absorbers under the new resolution framework. The legal reclassification of deposits is the key to understanding this system. When you deposit money in a bank, you are not placing money in a safety deposit box where it remains your property. You are making an unsecured loan to the bank. The bank takes legal ownership of that money and gives you a claim against the bank for repayment. This is fundamental banking law that has been true for centuries. What has changed is how that claim gets treated when the bank fails. Under the traditional FDIC resolution process, the claim was effectively protected even above insurance limits because the FDIC tried to arrange transactions that made depositors whole under the new bail-in framework. That claim is subject to write-down or conversion, like any other unsecured debt. Your legal status as a depositor is essentially the same as a bondholder who lent money to the bank. When the bank fails, both claims can be reduced to absorb losses. Now let me show you the additional provisions that make this even more concerning from a depositor protection standpoint. During a banking crisis, regulators have authority to impose temporary restrictions on withdrawals and transfers to prevent bank runs. These are sometimes called bank holidays, though that term understates their severity. During the Great Depression, President Franklin Roosevelt declared a national bank holiday that closed all banks for several days while the government figured out which ones were solvent. During the 2008 crisis, money market funds temporarily suspended redemptions to prevent mass withdrawals. In Cyprus, capital controls were imposed that limited ATM withdrawals to a few hundred euros per day and prevented transfers of funds out of the country. These controls remained in place for nearly 2 years. Similar controls could be imposed in the United States under emergency authority. The legal basis for this exists in the Trading with the Enemy Act, the International Emergency Economic Powers Act, and various executive orders that give the president sweeping authority to restrict financial transactions during national emergencies. These laws were originally designed to freeze assets of hostile foreign nations during wartime, but the language is broad enough to permit restrictions on domestic transactions if the president declares an emergency. During the 2008 crisis, serious consideration was given to declaring a bank holiday and imposing withdrawal limits if the panic had continued. The authority was never used because the TARP bailout and Federal Reserve interventions stabilized the system, but the legal framework was ready. That framework still exists and could be deployed rapidly if another crisis emerges. A combination of bail-in authority and capital controls creates a scenario where deposits can be frozen, then converted, or written down, with depositors having no ability to withdraw funds or transfer them to safety. You wake up Monday morning to discover that the bank has failed over the weekend. Your deposits above the insurance limit are frozen pending resolution. Capital controls prevent you from withdrawing cash or moving money to another institution. Several months later, you receive notice that 40% of your uninsured deposits have been converted to equity in the restructured bank, and the remainder is available but subject to withdrawal limits. The equity shares are worth perhaps 10 cents on the dollar. You have effectively lost half of your uninsured deposits with no recourse and no ability to have prevented it. This is not speculation about what might happen under some extreme scenario. This is the legal framework that exists right now. The authorities have been granted. The precedents have been established in Cyprus and in the resolution of several European banks. The FDIC has published detailed plans for how they would execute this type of resolution. The only reason it has not been used in the United States is that we have not had a large bank failure since these authorities were enacted. When the next major bank fails, and given the unrealized losses in commercial real estate, exposure discussed in previous analyses that seems increasingly likely as these mechanisms will be deployed, large depositors will discover that their understanding of deposit safety was based on outdated assumptions about how bank failures are resolved. The FDIC Insurance Fund provides additional context for why bail-ins are now considered necessary. The fund currently holds approximately $125 billion. This sounds like a large amount until you compare it to the $10 trillion in insured deposits in the United States banking system. The fund could cover roughly 1.25% of insured deposits. If a major bank with $300 billion in deposits fails, the insurance fund would be completely depleted trying to protect just the insured deposits at that single institution. If multiple large banks fail simultaneously, which is what happens during systemic crises, the insurance fund is woefully inadequate. The FDIC has a line of credit with the Treasury Department that allows them to borrow up to $100 billion to cover shortfalls, and that line could theoretically be expanded through congressional action. But accessing those funds requires political approval during a crisis, which is uncertain and slow. The fundamental problem is that the banking system has grown to a size where deposit insurance cannot credibly protect all deposits during a major crisis. The four largest banks in the United States, JP Morgan, Chase, Bank of America, Wells Fargo, and Citigroup collectively hold approximately $10 trillion in assets and roughly $7 trillion in deposits. If even one of these institutions failed, it would overwhelm the insurance fund and require either a massive government bailout or a bail-in of uninsured depositors. The political environment makes bailouts extremely difficult. The Dodd-Frank Act was specifically designed to prevent taxpayer bailouts. The realistic resolution mechanism for a large bank failure is bail-in, not bailout. This means that large depositors at major banks are the intended loss absorbers in the next crisis, and they are the buffer that protects the system and a taxpayer. Now let me show you the specific steps you must take to protect deposits from bail-in risk, because understanding the threat without implementing protection is worthless. The first and most important step is to ensure that all deposits are below the insurance limits at each institution. The FDIC insures $250,000 per depositor, per institution, per ownership category. This means you can have $250,000 in an individual account, $250,000 in a joint account with your spouse, $250,000 in a retirement account, and $250,000 in a trust account at the same bank, and all of it would be insured because these are different ownership categories. Most people do not structure their deposits to maximize insurance coverage. They keep large balances in a single checking account at one bank because it is convenient. This convenience creates massive risk. If you have deposits exceeding the insurance limits, you must immediately distribute them across multiple institutions to bring each account below $250,000. This is tedious and creates some operational complexity, but it is the only way to ensure that all your deposits receive insurance protection. Pay close attention to bank ownership structures. If you have accounts at Chase and at Washington Mutual, you have accounts at the same institution because JPMorgan Chase acquired Washington Mutual, the deposits would be aggregated for insurance purposes. The FDIC provides an online tool that allows you to verify which banks are separately insured. Use this tool to ensure you are actually diversifying across different institutions rather than just different branches of the same bank. The second step is to reduce overall reliance on bank deposits as a wealth storage mechanism. Bank deposits are appropriate for operating funds that you need liquid access to and for emergency reserves that must be available immediately. They are not appropriate for storing significant wealth. The combination of inflation, eroding purchasing power, and bail-in risk exposing uninsured amounts makes deposits a poor, long-term wealth preservation vehicle. Excess funds beyond operating needs and emergency reserves should be moved into assets that exist outside the banking system and cannot be bailed in. These include Treasury securities held directly through Treasury Direct rather than through a bank account, brokerage accounts at separate institutions from your bank, real estate, physical, precious metals, and other tangible assets. The key is that these assets are not deposits at a bank, and therefore cannot be frozen or converted in a bank resolution. The third step is to carefully select which institutions you use for the deposits you do maintain. Not all banks carry the same risk. Banks with strong capital ratios, low levels of unrealized losses, conservative lending practices, and diversified deposit bases are less likely to fail. Banks that are heavily exposed to commercial real estate, that have large unrealized losses on securities portfolios, that rely on uninsured deposits from concentrated sources, or that have weak capital positions are significantly more likely to fail. Unfortunately, this information is not easily accessible to average depositors. Banks are not required to disclose their unrealized losses prominently. Capital ratios are reported but are difficult for non-experts to interpret. The safest approach is to use the largest systemically important banks that are explicitly too big to fail. JPMorgan Chase, Bank of America, Wells Fargo, and Citigroup are so large that their failure would be catastrophic to the financial system. Regulators will do everything possible to prevent their failure or to resolve them in ways that minimize disruption. This creates perverse incentives where the safest place to keep deposits is at the largest and most systemically risky institutions because they are implicitly guaranteed by the government. Smaller regional banks may be better managed and less risky from a fundamental perspective, but they lack the political importance that provides implicit protection if you are going to maintain deposits above insurance limits despite the risks. And many people have no choice because business operations require large operating balances. Those deposits should be at the institutions that are too important to allow to fail completely. Even there, the risk is not zero. Uninsured deposits can still be bailed in if losses are severe enough, but the probability is lower than at smaller institutions. The fourth step is to maintain some assets in physical form outside the financial system entirely. This includes physical currency, though holding large amounts of cash creates security and logistical problems. It includes physical precious metals, particularly gold and silver, stored in a secure location that you control rather than in a bank safety deposit box, which could be frozen during capital controls. It includes tangible assets like real estate, where you hold title directly. The purpose of these holdings is not to generate returns, but to provide insurance against scenarios where the financial system freezes and electronic access to your wealth is cut off. During the Cyprus crisis, people who had physical cash and gold could continue operating even while their bank accounts were frozen. Those who kept everything in the banking system were helpless. A modest allocation to physical assets, perhaps 5 to 10% of total wealth, provides meaningful insurance without creating excessive inconvenience. The fifth step is to establish relationships and accounts at foreign financial institutions in stable jurisdictions, if your wealth level justifies the complexity. This is practical only for individuals with significant assets. generally above $7 million, because the compliance requirements and costs are substantial. But for high net worth individuals and business owners, holding some assets in Swiss banks, in Singapore banks, or other highly stable foreign jurisdictions provides geographic diversification. If the United States implements capital controls or bail-ins, assets held in foreign institutions are not subject to those measures. The foreign institution may face its own regulatory environment and risks, which is why jurisdiction selection is critical. Switzerland and Singapore have strong rule of law, stable political systems and banking regulations that provide robust depositor protection. Assets held there are more secure than assets held in many other countries, including potentially the United States, given the bail-in framework that now exists. The sixth step is to understand and use the different ownership categories to maximize insurance coverage for family members. A married couple can structure their deposits to obtain $500,000 in coverage at a single institution by having $250,000 in an individual account for each spouse. With the addition of joint accounts, retirement accounts, and revocable trust accounts, naming children as beneficiaries, a family can obtain several million dollars in insurance. Coverage at a single institution is structured properly. The FDIC provides detailed guidance on how to structure accounts to maximize coverage. Most people do not take advantage of these options and therefore have less insurance protection than they could obtain. The complexity is significant and requires careful documentation and account titling. But for individuals who must keep large deposits at banks for operational reasons, maximizing insurance through account structuring is essential. The seventh step is to maintain awareness of the financial health of your bank and the broader banking system. Warning signs include declining stock prices at your bank, widening credit default swap spreads, which indicate that markets are pricing in higher default risk, deposit outflows reported in quarterly earnings, increased borrowing from the Federal Reserve discount window, which suggests liquidity stress, and downgrades by credit rating agencies. If you see these warning signs at your institution, you should consider moving deposits to a more stable bank before a crisis materializes. During the Silicon Valley Bank crisis in March 2023, there were warning signs for weeks before the final collapse. The stock was declining. Analysts were questioning the unrealized losses. Informed depositors were moving money out. Those who paid attention and acted had time to protect themselves. Those who ignored the warnings lost access to their uninsured deposits. Now let me show you why the current banking environment makes bail-in scenarios increasingly likely in the near future. American banks are carrying over $1 trillion in unrealized losses on securities portfolios purchased when interest rates were near zero that have fallen in value as rates have risen. These losses are hidden through held-to-maturity accounting but represent real economic impairment. Commercial real estate portfolios are deteriorating as office vacancy rates remain elevated and property values decline. Many loans made in 2020 and 2021 are now coming due and cannot be refinanced at current property values and interest rates. Defaults are accelerating. Regional banks in particular are exposed to these risks. They lack the diversification and scale of the largest institutions. Several regional banks have already failed or been forced into emergency mergers. New York Community Bank shocked markets by disclosing massive commercial real estate losses and cutting its dividend. This is likely the beginning of a broader recognition of problems across the regional banking sector. When these banks begin failing in larger numbers, the FDIC will face impossible choices. The insurance fund cannot protect all depositors at multiple large bank failures. Taxpayer bailouts are politically toxic and legally constrained under Dodd-Frank. The realistic resolution mechanism is bail-in. Large depositors at failed institutions will have their deposits frozen and converted to equity in restructured banks or written down to absorb losses. This is not a possibility for some distant future crisis. This is the likely outcome for bank failures that could occur within the next 12 to 24 months, given current stresses in the banking system. If you have uninsured deposits at regional banks, you are sitting on potential confiscation targets. When those banks fail, the political dynamics make this even more likely. The public has no appetite for bank bailouts after the 2008 experience. Politicians have no incentive to vote for bailout packages that will be politically unpopular. The legal framework has been specifically designed to avoid requiring congressional approval for bail-ins. The FDIC can execute a bail-in resolution under its existing authority without needing new legislation. This means that depositor confiscation can happen quickly, over a weekend, without political debate or public warning. By the time you hear about it, the resolution has already been executed, and your deposits have already been seized. There is no opportunity to prevent it. Once the process starts, the 3 times in modern history that bailouts have been seriously implemented provide clear evidence of how this plays out. In Cyprus in 2013, large depositors lost up to 100% of uninsured deposits. In Italy in 2015, depositors at 4 small banks lost their uninsured deposits in bail-in resolutions. In Spain, during the banking crisis, preferred shareholders and subordinated debt. The holders were bailed in at multiple institutions, establishing the precedent that creditors would absorb losses. Each of these created temporary panic, but did not trigger systemic collapse. Regulators learned that bail-ins can work. They learned that you can confiscate deposits and impose losses on creditors without destroying confidence completely. This makes them more likely to use these tools in future crises because the precedent shows they are viable. The legal framework exists, the international agreements require it, the precedents have been established, and the banking system has sufficient stress that failures are increasingly probable. The political environment makes bailouts nearly impossible. All of these factors point toward bail-ins being the standard resolution mechanism for the next banking crisis. If you have uninsured deposits, you are volunteering to be the loss absorber when that crisis arrives. The banks are not going to warn you. They will continue accepting large deposits right up until the moment they fail. Regulators are not going to provide advance notice because that would trigger the bank run they are trying to prevent. You will wake up Monday morning to discover that your deposits have been frozen and that you have become an involuntary equity investor in a failed bank. This is not fear-mongering intended to create panic. This is a factual description of legal framework that exists and has been used in other jurisdictions. The appropriate response is not panic, but prudent preparation. Ensure deposits are below insurance limits, diversify across multiple institutions, hold some wealth outside the banking system, maintain awareness of your bank's financial condition. These steps protect you from bail-in risk without requiring you to abandon the banking system entirely. The system will continue to function for most people most of the time, but when it fails, for some institutions, the depositors at those institutions will learn that their money was never truly theirs once they deposited it in the bank. It became an unsecured loan to the bank that can be confiscated to recapitalize the institution during resolution. If this analysis provided understanding of the legal framework that permits deposit confiscation and the concrete steps required to protect yourself, subscribe to this channel for continued coverage of banking system risks and financial protection strategies. Comment below with where you are watching from and whether you have deposits exceeding insurance limits that need to be restructured for protection. The comfortable assumption that deposits are safe because they are insured is based on outdated understanding of how bank failures are now resolved. The law has changed. The procedures have changed. The precedents have been established in other countries. Your deposits are at risk if they exceed insurance limits and you have not taken steps to protect them. The choice is yours. The authority to seize deposits exists right now. The only question is when it will be used, not if.